With inflation at decade highs, the Feds began to raise interest rates in an attempt to slow down that inflation.
But what does this mean? And what do rising interest rates mean for your retirement?
All that and more on today's episode of The Retire Once Show. Hello and welcome to The Retire Once Show, a show designed to help you get to retirement, but most importantly, stay retired. I'm your host, Johnathan Rankin. I'm the founder and CEO of Theorem Wealth Management, and I'm joined by my lovely co-host.
Hi, I'm Melissa Rankin.
And today we're going to talk about interest rates. And I kind of think back, Mel, when I first started this business, my very first client 15 years ago walked into the office, and the investment that we bought at the time was a 9-month CD. Guess how much it was yielding?
I don't know, 15 years ago, 9 months, maybe 4%?
5.5%.
Oh, wow.
For 9 months.
That'd be nice.
It would be nice. And that's where I know a lot of retirement investors, at least a lot of our listeners, would love to get to at some point. But right now,
I'd love to get there.
Yeah, so would I. Right now, with everything going on with inflation, with the Fed's actions, they're trying to raise interest rates, and really it's in an attempt to curb that inflation. But eventually, we're going to get there. But there's a lot of steps between where we're at today on a 9-month CD and 5.5. Yeah. So that's what we're gonna go through today. We're gonna talk about rising interest rates and really what does that mean for your retirement. But before we jump into that, a couple things we want people to do, right, Mel?
Yes, absolutely.
What do we want them to do?
We want them to like us, 5 stars.
5 stars if you're listening on any podcast platform.
Click the subscribe button. And if you're watching us on YouTube, hit the like button. Hit that subscribe button. That way you're notified every time we come out with a new episode. So that's what we've got in store for you today. Those are the things we need you to do. But let's dive right in. Absolutely.
Rising interest rates.
It's a topic that we hear about often. I mean, why are interest rates rising?
So as we had talked about, the Fed is raising rates right now because inflation and really, prices are out of control at this point. We're seeing price increases. Prices are rising faster than they have in 40 years. And so because of that, what the Fed's doing is they're raising interest rates to make borrowing much more expensive so that people save more. There's less money circulating in the system. So that way we have slower growth and lower inflation.
They're trying to tighten those purse strings.
They are trying to tighten your purse strings. Now,
good luck.
The funny thing is that the Fed's wanted inflation since 2009, since the financial crisis. They've been begging for inflation. It was always, that was their target. That's why they kept rates extremely low. And so now that we've got this, bout of inflation, now it feels like a panic of sorts to say, well, we've got to raise rates and stop this inflation that we were begging for over the past 13 years. So that's really why interest rates are rising right now.
Okay, so let's shift gears a little bit. Now that we know why, let's talk about how it affects your portfolio. Okay. Let's start with cash.
So as I mentioned at the top of the show, CDs are not getting you 5.5% right now.
No.
But by looking at cash balances, a lot of our clients and a lot of retirees use cash and cash alternatives in that short-term bucket strategy, for their immediate use. And at some point, my hope is that we're going to see savings rates get back to a decent level where you're actually earning something on the cash you have in a money market fund.
Think we'll ever get back to that 5.5?
Maybe at some point. I don't know. That's like
pull out your crystal ball.
I do not have a crystal ball, but we haven't seen cash rates rise just yet on savings accounts. But we have started to see CDs creep back up. Now, when I say creep back up, I mean creep back up a little bit from where they were at the floor, not anywhere near those levels 15 years ago. So we've got a long ways to go until they're back to those levels, but we're starting in that right direction, which is what most retirement investors are looking for. I want to be able to be conservative, put my cash somewhere, but I still want to earn something, especially with all this inflation and prices getting more expensive. If I just put my money into cash, it's not doing anything for me to keep pace with that inflation. So it'll get there. It's just going to take some time.
Okay, so if cash is going to take some time, CDs are going to take some time. What about something that's not quite so immediate? What about bonds?
So bonds in a rising interest rate environment, that is That is a recipe for disaster. And that's kind of what we're seeing right now. Bonds do not hold up well in a rising interest rate environment. And, the reason why is that bond prices and interest rates are inversely related. What I mean by that is that as interest rates rise, the price of bonds fall. So think about it like this. The reason why that happens is that if you've got a bond that you bought, let's say a year ago, and it was yielding you 3%, well, the new bonds that are coming out for the same risk, the same duration, are now at 4%.
Nobody wants the 3%.
Nobody wants the 3%. So for you to sell that, you're going to have to offer that at a discount. So the way I like clients to think about this is, if you have bonds, as rates go up, think of those bonds, they're used bonds. It's kind of like a used car. How much are you really going to pay for a 2005 Toyota Camry? If the new Toyota Camrys are coming out, you're not going to pay the same price. You're going to have to sell yours at a discount. Whereas when rates go down, now that bond that you had, that's a collector's item. It's like a 1960 Ford Mustang. At least I think. I'm not a car guy, so I'm going to assume
that's the extent of his car knowledge right there.
All I keep thinking about is that Gone in 60 Seconds, the Shelby GT Mustang. I think the name of the car was Eleanor, if I remember correctly.
Oh, that you remember.
I do remember Eleanor, but that's the way you want to think about interest rates and bonds. As interest rates go up, you've got a used bond, and
that you need to sell at a discount.
Yep, and if rates go down, you're going to have a collector's item on your hand, because the new bonds that are coming out, they're not offered at that that rate that you got yours at. So that's really the reason why we've seen bonds so far this year really have a hard time performing. I mean, they're down, as of us recording this show, down over 5% year to date.
Okay, so with that in mind, why would you even own bonds at all over cash?
That's a really good question. We've gotten that quite a bit lately, especially with the underperformance of bonds that we've seen. And what I've told clients is that it's really important that you match up the duration of the bonds you're holding with the duration of when you're actually going to need those funds. So let's say that you've got a pot of money that you're not going to need for 3 years. You're likely going to get a better rate of return in a 3-year bond than you would just putting that money in cash. Likewise, if you needed money, let's say in 7 years, you're probably going to get a better rate of return in a 7-year bond than you would in either cash or even in a 3-year bond.
Okay. So just being realistic about when you're actually going to need the money.
Absolutely. So the important thing is, if you're owning bonds, is to look under the hood and see what is the duration of what you own. If you're owning a bond ETF or a mutual fund, what is that duration?
Real quick, if you're just tuning in, I just want to remind everybody, this is not a show about cars.
No.
We've talked about looking under the hood, Mustang.
Eleanor.
That's
right. So that's what, if you have any bonds in your portfolio, that's the important part, is just to make sure that you understand the type of bonds you're owning and really the duration of those bonds.
Okay, so now that we've covered how rising interest rates can affect your bonds and your immediate use things, what about how they affect your portfolio as far as stocks go?
So I wish this was as straightforward as bonds. Unfortunately, it's a little bit more complicated than just rates go up, this is what happens to stocks, because there are a number of factors when looking at what drives stock prices. So, on the business side of things, as you see higher interest rates, well, that means higher cost of borrowing for certain companies. That means that it's going to be a little harder for certain companies to grow, because for them to go out and take on debt, it's going to cost them more, which is likely to result in lower revenue, lower profitability. So if you're a stock analyst and a stock investor, you might go, well, their profitability isn't as good as what it used to be. Maybe I don't want to buy that stock. So you might see that in certain sectors of the market, but there are certain sectors that actually do well in a rising interest rate environment. Things like financials, those tend to do a little bit better just because they can pass those higher interest rates on to the consumer.
By way of what? Credit card rates, things like that?
Higher credit card rates, higher mortgage rates, higher just lending costs in general.
Okay.
And so they're able to make a higher margin on those loans that they're providing. And at the same time, I think we all know how much we're getting on our savings accounts right now at 0.01 or 2 maybe. So it's
definitely not that 5.5 you were talking about 15 years ago.
Not the 5.5%. So they're not passing the benefit on just yet, but they're definitely raising rates on their lending. So that's how those
being
type
much
of
more stringent.
Yep. And so, another aspect that is impacted with rising rates is this concept of equity duration. So we talked about bond duration in terms of, how long of a bond do you own? Do you own a 30-year bond, 10-year, 5-year, any denomination? Most people don't think of stocks in the concept of duration.
I mean, you think you have a stock, you're prepared to sell it or hold it or whatever at any given time.
Yep. But what I mean by equity duration is how sensitive is a certain stock's cash flow to the discount rate, to interest rates, essentially. And so you think about, why do we own stocks? Well, we all own stocks to have partial ownership in a company's cash flow. So one of the most common methods that a lot of portfolio managers and analysts use is what's known as the discounted cash flow method.
And what is that?
So that is where an analyst will analyze a company and project out their future cash flow into the future. And then what they do is they take that cash flow and they discount that back to the present day to figure out, what is this company worth today? Now, to calculate that present value, you need to have some sort of discount rate, or better known as an interest rate. And so,
which is why the current interest rate is so important.
Absolutely. And that's why now you're thinking about it very similar to bonds, where as interest rates go up, the value of that company, the value of that equity goes down.
Okay, that makes sense.
And that's why what we're seeing right now is that companies that are longer duration, so you think of growth companies where they don't have a mature cash flow like value companies. Value stocks typically have already established cash flows. They're less susceptible to the rise in interest rates. But if you're a company that is in growth mode and you're not necessarily turning a profit or delivering any sort of dividend or real cash flow to an investor, it's just hey, at some point we're going to grow to that. Well, now that discounted present value is going to be lower than what it was even 5 or 6 months ago. And that's why we're seeing a bigger pullback in an index like the NASDAQ than we are in the Dow, just because you've got more mature cash flows in the Dow and you've got a lot more growth companies in the NASDAQ. So that's the relationship that you're seeing with interest rates and stocks.
So should people go out and sell all of their growth stocks?
No, this is not a call to go out and sell all of your growth stocks, but it is a time where you really want to analyze the holdings you have. Understand what is your interest rate susceptibility, because the reality is that most investors have been overweight growth since 2009, because with interest rates near zero for 13 years.
A long time.
The reality is that growth companies did do well over that entire time frame because, for the most part, you can discount those numbers back and it's going to lead you to a higher equity value. But now that we're starting to see that, that trend switch where we're going into this rising rate environment, I think that that switch from growth to value is changing as well.
Okay, so that's kind of how it affects the stock market and all of your money essentially that you have right now. What about how interest rates affect your retirement planning? So there's a number of different things that it affects when talking about just the concept of retirement planning. And I think the first one that comes to mind is, lump sum pensions. So we've got a lot of clients that have a pension. I don't know any single person that is our age that has a pension, but we do have the idea of a pension.
I would love to have a pension, but we know a lot of clients that were at large organizations that at some point had a pension, and there's a decision that needs to be made at some point, if offered, that do you take a lump sum or do you take the monthly annuity where it's a cash flow?
I've often contemplated that as well if I won the lotto, because I think that's one of the options too, isn't it?
Yeah, lump sum or taking the annuity. So same type of thing, but when looking at a pension, think of a pension as exactly what it is. It's a long-term cash flow. So if you were to figure out what is that worth today, well, you have to discount that back to present value, which means you need a discount rate, essentially an interest rate, and it's the same thing.
All goes back to the interest rate.
All goes back to the interest. So as interest rates go up, that present value calculation of lump sum will likely go down. And so
same kind of thing as we talked about with bonds and stocks.
So I know some clients that have left a company that had a pension, and they have this option of they can let it defer and wait until they're a certain age, and they can make a decision of taking an annuity payment or taking a lump sum. But if you have the ability to analyze that now. Like you've got a pension that's just sitting there. Maybe it's time to really assess whether or not it is best to take the lump sum now or just take the long-term cash flow. So that is something that will be affected. So another thing that rising interest rate affects is housing in terms of clients that want to relocate or refi their mortgage. It's going to affect mortgage rates, and we're already starting to see that. If you have an old adjustable rate mortgage, well, that's going to start adjusting at a higher rate. So it could impact your cash flow. Yeah, it could really impact your cash flow if you've planned for retirement to be a certain amount per month or per year, and now your mortgage is rising because of rates. So the one thing to keep in mind. Another thing is credit cards. So really any type of consumer debt that you have, especially adjustable rate mortgages and credit cards, because those are variable. Yeah. So those, look at that. We're so in sync.
Finally.
So
you had me at credit card.
So those are ways that it can affect your cash flow, month to month or year to year.
I know that you talked about how it can affect businesses and a little bit when we were talking about stocks and growth versus value, things like that. But how do rising interest rates actually affect businesses and companies and employers and things like that?
So because now it does cost more to take on loans. So that's what a company's doing. When they go out to the bond market and they issue bonds, really they're taking a loan from the public. So now that loan costs more, maybe they don't take as much of a loan. Maybe they don't take one at all because the cost is too high. And so if they don't have that money, maybe they're not hiring. Maybe they have to cut back on their employees right now. And so you might see layoffs at some point. And this isn't saying that every company is going to start laying off people because higher interest rates are there, but the cost of business is going up. And so because of that, businesses will likely slow down. So just from an employment standpoint, if you're not building new factories or building new stores, well, you don't need workers to work those. Or
expanding, things like that.
You don't need workers to work those, into that expansion if you're not expanding. So I think from a business aspect, that's one thing that, for those who aren't retired and are a long ways away from retirement, we kind of talked about this in our recession episode last week, where, if you are, if you're in a company that is, taking on a lot of debt, maybe that's something you're aware of.
Okay, so now that we've talked about how it affects businesses and people spending money, the people who aren't necessarily in retirement, what about the people who are trying to save for it? Like if you have a 401k, for example, instead of a pension or something like that.
Yeah, so for 401k investors, I feel like rising interest rates is going to be a real challenge. And the reason why is that most 401ks have very little diversification options in terms of bonds within a 401k. I mean, we typically see one or two bond funds. Usually it's like a stable value fund or an intermediate bond fund, but there are no exposures to high yield or treasury inflation protected securities or, senior loan notes or emerging market debt or international bonds. Usually it's very limited. And so, the ones that I just mentioned, those are a little bit less sensitive to rising rates, whereas your traditional intermediate bond fund can be a lot more susceptible than high yield or any other type of bond. So trying to figure out how to remain diversified in bonds within a 401k is going to be challenging. And so I think for those that are listening, you really want to understand the type of bonds offered in your 401k. I would definitely look into the duration of those bonds. And then at the same time, you want to look at possibly some of the target date funds that are offered in 401ks, because so those do sometimes have diversification into different types of bonds that aren't offered as a single standalone fund.
So eventually, higher rates have to be a good thing, right?
Yeah, go back to that 15-year ago client at 5.5%. At some point, it's going to be a great thing, especially at some point, especially for retirement investors. I mean, this is what we've as retirement advisors, this is what we've been hoping for, is that you get to a point where you can say, okay, for very little risk, we can, get a CD or a bond that's giving you 5 or 6%, but we haven't been in that environment for 13, 14 years, if not longer. So eventually we'll have higher income on cash and fixed income. It takes some pain to get there. It's definitely painful to get there, especially if you're investing in bonds or really long duration assets.
So kind of going through the interest rates and them rising that we're seeing now, it really is just kind of like a growing pain of the market or life. I mean, it affects everything.
Yep. It's a growing pain, just like our daughter's sleep regression was.
Another big growing pain.
So the key right now is to just analyze what you're holding. Go through and make sure you know what it is you own. What are the sectors? How sensitive are they to interest rates going up? Because the reality is we're not done yet. The Fed's raised rates one time, and the projections on the street are anywhere between four times or up to, I've seen up to 9 or 10. So there's a lot more interest rate hikes on the way. So just make sure you understand what you own. Buckle up and understand what you own is the key there. So
is that what you would say to our listeners? Is the most important things just know what you own?
Know what you own. Know the sensitivity that each one of those investments has with interest rates. And if you don't even know where to start, because a lot of people don't know where to start. And I think that's the hard part. You go, okay, well, I've got this 401k or investment that I've put together over the course of decades. How do I go about analyzing this? Because
where do I start?
Well, let's just face it. A lot of investors bought investments, especially in their 401ks, based on a 3-year performance number, or a 1 year, or a 5 year, or a 10 year.
Well, when you get just a list, you're going through and you're looking at, okay, this one's the best. This one's the best.
Exactly. So, but the reality is that what got you to this point is probably not going to get you where you want to go. And so, analyze what you own. And if you don't know where to start, we'd be happy to help you. There is a link in the show notes below to schedule a call with us.
We'd be happy to talk to you, happy to look over everything for you.
Yeah, so just reach out to us and we'll help you analyze what you own, and we'll just figure out, okay, what purpose does this make in your portfolio? So I think that's the key. And, with everything going on, retirement is supposed to be a good time. This isn't
still supposed to be fun.
This isn't a call to just try and stress you out and say, well, rates are rising, go out and make all these changes. It's just one of the things you want to be aware of. And so with that, before we get out of here, what do we want people to do? Tell them again.
Subscribe. Definitely subscribe.
Subscribe. Hit the like button. If you're listening on podcast platforms, 5-star reviews. We really appreciate it. And with that,
remember, you're retired, not expired.
No, you're not. I'm Johnathan Rankin.
And I'm Melissa Rankin. Thank you for joining us.